Understand this. On January 26, 2026, silver hit a price nobody had seen in the entire recorded history of the metal, $121.64 per troy ounce. People were calling it the trade of the century. Financial media was projecting 150, then 200. The word moon was appearing in serious investment commentary, written by people who should have known better. 4 days later, it was over. Not slowly. Not with warning. In a single trading session, silver collapsed nearly 30%. 30%. In one day. Millions of people who had bought near the top, ordinary people, not Wall Street traders, people saving for their future, watched a third of their money disappear before dinner. Here is the question you need to sit with right now. If silver is still up 87% over the past year, even after that crash, does that make it a buying opportunity today, or a trap waiting to close again? By the time this is over, you will know exactly how to think about that question, not what to think, how to think, and that distinction is everything. Welcome to OG John Hub, where we break down what is really happening with your money. Let us go back to where this story actually begins, because January 26th did not come out of nowhere. Silver entered 2026 already elevated, trading around $71 per ounce, which was itself historically high. But a specific sequence of events had been building pressure beneath the surface for months. In early 2025, silver was trading at approximately $30 per ounce. Unremarkable, steady, the kind of price that does not make headlines. Then three forces arrived almost simultaneously and changed everything. The first was global inflation anxiety. Central banks had been cutting interest rates, but inflation was proving stubborn in ways that made investors nervous about paper currency. When people lose confidence in paper money, they have historically moved toward hard assets: gold, silver, real estate. The pattern is ancient and reliable. The second force was industrial demand. Silver is not just a precious metal, it is a critical industrial input, used in solar panels, electric vehicle components, semiconductors, and medical equipment. The clean energy transition that accelerated through 2025 was creating genuine new demand for physical silver that had nothing to do with investment speculation. This was real demand: factories, production lines, supply chains. The third force was the one that lit the fuse. On January 1st, 2026, China announced a reclassification of silver as a strategic dual-use material. What that meant practically was that China, the world's largest industrial consumer of silver, was signaling it intended to stockpile the metal for national security purposes. When the largest buyer in any market announces it is going to buy more, prices do not move gradually. They move immediately and violently. By January 26th, silver had gained more than 300% in 12 months. The largest annual gain the metal had recorded since 1979. Think about that number. 1979. That is how rare this kind of move is. And then, the CME Group made one decision that changed everything. The CME Group is the world's largest futures exchange. It is not a household name, but it controls the plumbing of global commodity markets in ways that affect every investor whether they know it or not. On January 30th, 2026, the CME raised margin requirements on silver futures contracts to 15%. If you have never traded futures, that sentence probably sounds technical and distant. Let me make it concrete. Imagine you are controlling a silver position worth $100,000. Under the previous rules, you only needed $5,000 of your own money posted as collateral. The exchange was essentially lending you the rest. Your $5,000 was controlling $100,000 worth of silver. Now suddenly the rules change. That same position requires $15,000 in collateral. Immediately. Not next week. Not after you have had time to arrange the capital. If you do not have that money sitting in your account right now, your position is automatically liquidated, sold, gone. You do not get a phone call. You do not get to make a decision. The system does it for you, and this happens simultaneously across thousands of accounts. That is not a typo. Thousands of accounts, forced to sell, all at once. The resulting wave of selling hit a market that was already stretched beyond its fundamentals. Silver did not drift lower. It fell through the floor, roughly 30% in a single session, the kind of move that takes most assets years to recover from, happening between the opening and closing bell. If this is the kind of honest, clear breakdown you have been looking for, hit that like button right now and subscribe to OG John Hub. Every week we bring you exactly this, and share this video with one person in your life who needs to hear it. But the margin hike was only the first wave. Algorithmic trading systems now account for the majority of all market volume on any given day. These systems do not feel fear. They do not hesitate. They are programmed to respond automatically when specific price levels are crossed. And when silver broke through key technical thresholds on January 30th, thousands of algorithms generated enormous additional sell orders within milliseconds. Not because any human being had made a judgment about silver's value, because a line on a chart had been crossed. Simultaneously, the Federal Reserve was signaling a pause in interest rate cuts. That signal pushed investors globally toward US dollar assets. And here is the relationship every serious investor must understand and internalize. Silver is priced in US dollars on global markets. When the dollar strengthens, silver becomes more expensive for every international buyer paying in euros, yen, or yuan. Demand from those buyers softens. And when demand softens into a market already drowning in sell orders, prices do not decline gracefully, they collapse. There was also a geopolitical layer that most coverage missed entirely. Rising tensions in the Middle East related to the Iran conflict were driving energy prices higher. That simultaneously stoked inflation fears and pulled capital away from precious metals toward energy assets. Investors were rotating, fast. 5 distinct forces arrived at the same moment: the margin hike, the algorithmic cascade, the strengthening dollar, the ETF outflows as retail investors panicked and fled silver funds, and the geopolitical capital rotation, not one after another, all at once, like 5 people pushing the same door simultaneously. The result was not just a bad day in silver, it was a demonstration of exactly what modern leveraged markets look like when structural pressure overwhelms normal price discovery mechanisms. Actually, let me put that differently. It was a demonstration of what happens when millions of investors own an asset without understanding the rules governing that asset. The crash did not reveal something new about silver. It revealed something old about human behavior. So where does that leave you today? As of June 2026, silver trades at approximately $67 to $68 per troy ounce. That is 44% below the January peak of $121.64. Devastating if you bought at the top. But here is the fact that demands equal attention. Silver at current prices is still roughly 87% higher than it was 1 year ago. The investors who bought early and held through the crash are still sitting on extraordinary gains. The investors who bought at the peak using borrowed money were destroyed. That gap in outcomes was not determined by luck or timing. It was determined by understanding. The first thing these events teach is both simple and endlessly ignored by the people who need it most. No asset rises indefinitely. When silver gained 300% in 12 months, it was not because the underlying supply and demand fundamentals of physical silver had improved by 300%. That would be impossible. What happened was the accumulation of speculative leverage on top of genuine fundamental drivers. And speculative leverage, borrowed money betting on continued price increases, is always borrowed time. The CME margin hike did not cause the crash in any ultimate sense. It accelerated the unwinding of an excess that had already made itself inevitable. Think about that. The match does not cause the fire. It reveals the fuel that was already there. The second thing worth understanding is that the rules of any market can change with minimal notice. The CME announced its margin adjustment, and the consequences unfolded within hours. Investors who had not taken the time to understand how futures margin mechanics work, who had not asked themselves what would happen to their position if the exchange changed its requirements, were not victims of bad luck. They were victims of incomplete education. And there is a meaningful difference between those two things. Understanding the structure and regulatory environment of any market where you place capital is not a refinement of good investing. It is the foundation. Without that foundation, you are not an investor. You are a passenger in a vehicle whose controls you do not understand, hoping nothing changes. The third thing is about technology as an amplifier of everything. The algorithms that cascaded silver lower on January 30th were not malicious. They were doing precisely what they were designed to do. The problem is that when thousands of systems respond simultaneously to the same signal, the result is not orderly price adjustment. It is a feedback loop that no individual investor provoked and no individual investor can stop. This is the environment in which every investor now operates. whether they acknowledge it or not. The appropriate response is calibration, not despair. Calibration. The fourth thing is about diversification, not as a slogan your broker says because it is safe and unremarkable, but as an actual structural principle for financial survival. The investor who held their entire portfolio in silver on January 30th lost 30% in a single session. The investor who held equities, bonds, real estate, and commodities was protected by the simple mathematics of uncorrelated assets. One position falling does not have to mean everything falling. That is the entire point of diversification, made brutally visible. So back to the question you came here with. Should you buy silver now or run? Here is the honest answer, and you deserve honesty more than you deserve comfort. Silver at $67 still has genuine fundamental support. Industrial demand from the clean energy transition has not disappeared. China's strategic interest in the metal has not reversed. The macroeconomic conditions that drove the initial rally have not been resolved. But silver is also not the same trade it was at $30 in early 2025. The easy money in that move has already been made and taken by investors who understood what they owned and why. The question for you is not whether silver is a good asset. The question is whether you understand the rules of the game well enough to play it without getting hurt. If you are considering silver today, consider physical silver or regulated ETFs over leveraged futures positions. Consider it as one part of a diversified portfolio, not a concentrated bet. Consider your time horizon in years, not weeks, and never put capital into any position that you cannot afford to hold through a 30% single-day move without panicking, because that move can happen again. Not necessarily will, but can. And the investor who knows that going in is a fundamentally different person from the one who discovers it mid-collapse. Leave your answer in the comments right now. Given everything you just heard, do you think silver will reclaim its January high within the next 2 years? And what do you think would have to happen for that to occur? I genuinely want to read what you think. And remember, everything discussed here is for education and discussion only. This is not personal financial advice. Your money, your decisions, your responsibility. See you in the next one.